started very, very early, right when he was 18 years old, set up $600,000 or about that much into his management fund, and then raised a separate, obviously, fund for the actual investment, $6 million there, performing well. We'll see what he does over the next 5 years.
This is The Top, where I interview entrepreneurs who are number one or number two in their industry in terms of revenue or customer base. You'll learn how much revenue they're making, what their marketing funnel looks like, and how many customers they have.
I'm now at $20,000 per top.
5 and 6 million.
He is hell-bent on global domination. We just broke our 100,000 unit sold mark.
And I'm your host, Nathan Latka. This is episode 756. Coming up tomorrow morning, Emily joins us. She launched a $20 million cannabis VC firm after her parents passed away. So what's the connection? Hello, everybody. My guest today is Julian Marchese. I was introduced to him by a mutual friend, but he is the CEO and portfolio manager at Marchese Investments in New York, or Marchese Investments in New York City. Now, the background of his story, we'll get it right, Julian, right? We'll get it right. The best part about his story, though, he's only 21 years old. He's been featured on Bloomberg, CNBC, and the hit TV show Dragon's Den, which is basically Shark Tank in Canada, where he managed to get 4 out of 5 dragons in the den to show interest. In 2016, he raised $5 million for his hedge fund. So we're going to dive into that today, obviously see where his brain's at. It'll be a lot of fun. All right, Julian, are you ready to take us to the top?
Yes, sure, Nathan. Thanks for having me on the show.
Of course, like most people that graduate college, they're thinking about landing their first $60,000 per year job somewhere, very safe. You do the opposite. Sure. Why go into kind of the hedge fund world?
Why go into the hedge fund world? Well, I mean, it's just my passion. It's what I wanted to do since I was like 12 or 13, basically. When I was 11, I found out about the world of investing. My parents had always taught me earlier on to, that wealth equals freedom in our society. And so I did all the traditional, lemonade stands, backyard fairs, and I would make some money, and I'd go, well, what do I do with this money, right? And so just a few Googles when I was 10 and 11, investing came up. I happened to watch the movie Trading Places. I don't know if you've seen that flick, but at the end of that movie, they show in the early 80s the floor of the New York Board of Trade, where they were trading gold, silver, orange juice futures. And after I saw that scene, I was like, I have to do this stuff. Whatever they're doing, I want to do. So basically, since a very early age, I immersed myself in the world of hedge funds and trading, and I've never looked back. So the moment I turned 18, I was like, let's start a firm. I started my firm.
Why did you wait until you were 18?
Legality. I can't manage other people's money until I was obviously of legal age. So yeah.
Got it. And then, so walk me through, someone with your background, obviously you're just coming out of school, you're 18. How do you raise kind of your first dollar of capital, and what have you raised to date?
So, I've been lucky enough to have been building a media presence and a brand from a very early point, right? So when I was 11 and I first got into it, I took a course in Toronto, where I'm from, Canada, Toronto. And basically there was some media there of the Toronto Star, which is one of our biggest newspapers, and they saw this young kid amongst, 40 and 50-year-olds learning about trading. And so, this lady walked up to me, started talking with me a little bit, and they decided to do a story. And really from that point on, the media just sort of fell into place, I didn't really sought after it, but it just sort of came to me. And that's really what's helped me propel my business initially, because my first few investors were just people that, saw an article on Business Insider or saw one of my interviews and said, hey, that's a really great story. I'd love to learn more about what you do. And then, one thing leads to a meeting, and then a meeting leads to an investment. And yeah, that's
what are you showing?
Let's
let's role play for a second. I just saw you. Sure. I read you on Business Insider. I find your email online somewhere. I send you an email and say, hey, I'd love to learn more. What do you reply with in that email?
Okay, so, I'll just tell you the story of how it all began. There was a lady back, this must have been 4 years ago. Yeah, in 2013.
What was her name?
I just started a club called Leaders Investment Club. Her name is Lorena.
Okay.
I just started a club called Leaders Investment Club, and Lorena had it's a club basically for younger people really interested in investing and trading like I am. So I wanted to build a little community and network basically of like-minded individuals with an end goal of promoting financial literacy for all young people. Anyways, this lady emails me because she really wanted her daughter to be in Leaders Investment Club. And she was a teenager herself trying to get into investing. And so she sent me this, very thoughtful, long email message, explaining how, she's read my story and she really wants her daughter to be associated with the club. And, she happened to be in Toronto. I met up with her and her daughter. And back then I was 16. So my parents were also with me at the time. I didn't have my license to drive yet. And basically 2 years later, I maintained that relationship, and she invested $75,000 for 1% of my management company. So, I was able to get a really good valuation, of course, on just, founding my hedge fund. And it all came from just, one email for something totally different.
And how much have you raised to date for that management company?
For the management company, I've raised $675,000 at about an average valuation of like $4 million. And so I've raised about $5 million into a separately managed account program at this point. But we're looking to launch a fund later this year.
Well, what are the differences between that management company that you raised 600-ish for and the other thing that you raised $5 million for?
So, traditionally, if you look at a hedge fund, it's multiple entities, right? There's an LP, a GP, and the management company. The LP is the fund with which all the investors invest in, and then the LP hires the management company to manage its assets. And then
an LP is limited partner,
GP is the general partner, which all the profits flow to, and all the management fees flow to the management company. And so, people, whenever they're investing in when I'm talking about that $675,000, that's all operating capital to be spent, right? That's not in the fund. So
do you pay yourself a fee on that though?
Pardon me?
Do you pay yourself like that $675,000 when you say operations costs? Like, what is I imagine do you pay yourself a salary out of that?
Yeah, that would include salary, but I mean, initially I'm not looking, other than paying my bare living expenses. That's about it.
What is that in New York? I'm curious. What have you been able to manage your expenses to?
It's about, it's expensive. It's New York City, so it's $2,500, $3,000 a month.
Yep.
Around there.
And then what are your other big costs? Just only on the management company side?
On management company side, it really depends on what stage you're at. Right now my biggest costs are administration, accounting, tax. Usually once we grow and we build an institutional team, most of the costs are just salaries, because the entire value of a hedge fund is basically intellectual property and human capital, right?
How does that first lady that put in that $75,000 though, and everyone else that then put in up to about $600K in the management company, how do they get a return on that money? Because do you sell a management company?
They can. It's very possible that down the road, as the fund grows, obviously the management company will have a larger enterprise value, and they would be free to sell it, of course, with my permission. But really, what they're making money from is their GP interests. So when, let's say down the road, we're managing $1 billion and we make 20% in a year, that's $200 million. We take a 20% performance fee, let's just say, to make it real simple, that's $40 million. If they own, 1% of that $40 million, that's $400K.
Got it. You're actually paying that out to yourself and to anyone else who owns equity in the management company.
So hedge funds have two fees. They have the traditional fee structure is 2 and 20. So a 2% management fee. So basically 2% of all assets every year. That goes to paying down salaries and just operational costs. And then the 20% performance fee, which is totally based off of performance, that goes to the shareholders and the portfolio managers as bonus, effectively.
Got it. Okay, let's switch over to the $6 million side. How did you raise that capital at such a young age?
Value generation. So I've been managing money since October of 2015. I'm up about 28% since then, with an uncorrelated return stream. So not only have I been able to just about beat market returns over that period, and the market's just been going up and up and up, obviously, but we've also done it in an uncorrelated fashion. So our best months over this period happened to be months where the market was actually down. Mm-hmm. So I run a quant multi-strategy shop. We're not buying and holding. We're on average holding positions for 3 days, 4 days. So we're in and out. We're looking. So
tell me about the last deal you did.
Pardon me?
Tell me about the last deal you did.
So the last deal was an institutional money manager, basically a multi-manager platform. So they run about 250 million, and they split that capital across many emerging managers like me. So emerging managers is basically anyone under like 50 million in assets under management. Because obviously the hedge funds industry is really big, $3 trillion.
Wait, Julian, sorry, I think I asked the wrong question. Of that 6 million, tell me about the last time you took a chunk of that and put it in another company and got a return.
Oh, okay. So again, what I'm doing is not traditional investing, right? I'm literally, the positions I have on right now today could look very different next week.
I understand that, but I want to really get real and understand what it looks like. So can you, tell me the story, one that you can share publicly.
If you want my largest positions, what I'm doing in the fund.
Just tell a story of one investment you made so my audience can understand how it works.
Okay. See, this is going to be a little tricky because it's I'm not doing anything traditional. People would have to have a little bit of
do your best
understanding.
Look, the most brilliant people can explain very complex things very simply. So do your best.
Sure. So basically, there's volatility, right? We're able to trade volatility. We're able to bet on how much the market is going to move up or down. And systematically over, if you sell volatility. So most people buy volatility, expect volatility to increase as sort of like a hedge, right? Most people are invested in the stock market, and they want the stock market to go up. They want stocks to go up, and so they want some kind of protection if the stock market goes down. Think insurance, basically. Mm-hmm. So one of the strategies we run, and it's actually our second largest strategy, is basically systematically selling insurance to those market participants that are really long and want the market to go up, so that when a crash does happen, we are going to have to pay out sometimes, but there's a really big premium over time of shorting that volatility, and you're basically you can beat the market just because of that insurance premium.
Mm-hmm. So if I put $1 million, of the 6 million you raised, if I was $1 million of that, and I guess that was 2 years ago you raised that, or a year ago?
Mm-hmm. Yeah.
So if I was $1 million of that, when do I actually start seeing money coming back into my bank account?
That's up to you. We really have monthly liquidity at this point, so you can invest. Come out basically at the end of the month with a month notice. Let's say I put $1 million in, and then I want to take that $1 million out a year later. What additional upside do I get? What else do I take out to make it worth that investment? Are you asking what our average annual return is, basically?
No, that would be the term in your world. I want to actually make it real, though. So if I put $1 million in, and your year right when you started, and I decided, hey, Julian, I want to take $1 million out at the end.
I'll answer it simply. If you put $1 million in when we started in October 2015, today you'd have about $1,200,000.
And I would take out that.
You can take that out totally if you want. Yeah.
Okay. Or I could just take $1 million out, just so I'm back playing with casino money, and leave the $200,000 that you've made me in.
Totally. And right now, since we're doing separately managed accounts, we do have some flexibility in that we can tailor individual clients. We can basically say, hey, if you want to manage 200,000, traditionally we're trying to make you 15% to 20% a year. But, you know, if you want to take bigger risks, we can, you know, ramp that up to 40%, 50%, as long as you're obviously comfortable with the volatility associated.
So what are you most concerned about? Like the hedge funds go under all the time. Why do they go under? And like, what are you constantly worried about?
That's a good question. I mean, I personally don't worry too much about like macro events like most hedge funds do, right? A lot of hedge funds, when they blow up, or what you hear about, right? That's also media, right? Most hedge funds, of course, don't blow up. These are sophisticated, you know, investment vehicles, but you know, that they're usually caused by some kind of systemic event, like the stock market crashing or Brexit or one of those things. Those aren't the things I really worry about. I worry more so about the process, my investment process, and how I develop individual systematic strategies. Because the real risk to what I'm doing is if I got something wrong in the analysis process that you know, basically means that my system doesn't have any statistical validity like I thought it did. And that would obviously reflect in negative returns. And it's really difficult to sort of be able to tell, and it's a bit of an art to be able to tell when, you know, a certain strategy isn't doing so hot, because strategies are cyclical, right? They make money, they lose money over time. Obviously, you have some kind of positive expectancy. But it's being able to maneuver around, you know, the negative periods that are really important. And we have a real big advantage over that, being a multi-strategy fund, because each individual strategy doesn't really have too much exposure. Think diversification, right? We take diversification to a real
but I feel like, I mean, this is like a pitch that you'd hear from a lot of different hedge funds that are raising capital. They still, many of them go under. In fact, there's probably media bias towards the successful ones. We hear more about the successful ones than you read about the ones that have all gone under. It's called success bias. So like, you haven't answered my question, which is like, what would make your hedge fund basically go bankrupt, go out of business? What is your biggest risk, like specifically?
A statistical anomaly, and again, it's the same answer. It's not a macro event for us. We don't have beta exposure most of the time. Beta exposure meaning market exposure. So the stock market crashing 10% tomorrow doesn't really affect us. If anything, we may make money off of a move like that.
Yeah, but I was about to say, you told me you bet on volatility, and then you said you didn't care about something like Brexit. Well, that was like a great volatility moment. So I'm having troubles understanding, like, you're taking credit for volatility on the upside, but you're not articulating to me what the downside is.
Multi-strategy. So none of our strategies are correlated with each other. That volatility strategy has a certain return stream where it makes money during certain times and loses money during different market environments. We tailor the portfolio in such a way that certain strategies will literally not have exposure when other strategies do, right? So if I build a system that trades oil on Mondays intraday, and I have another system that trades gold on Thursdays, there's no way for them to both lose at the same time, literally, right? And so really the main risk is if I just built these strategies incorrectly, with which they all just start losing money at separate times over time. But there's no one event, right? Like Brexit, it could affect our that volatility strategy, but it's a selective strategy. It's not always in the market, right? We may be in 30% of the time. So it really depends.
It makes me really suspicious. It makes me really suspicious when you can't give me a scenario where you tell me where you wouldn't perform like better than the stock market. Either it tells me like you haven't thought about it, or like you just don't want to show those cards. Like this happens all the time, where hedge funds earn way less than the market, and they have these you know they articulate it just the way that you did. So are you saying? I mean, I
don't think so. No, that's not true.
So you're saying if we put your money with you, there's no way. No, Julian. If you say, if I put my money with you, there's no way I'm going to lose money. That's basically what you're saying. Okay, so tell me exactly how I would lose money. That's what's going to give me confidence. I'm going to say, oh, Julian totally understands his risk.
I literally told you.
You said if I put money, you said my strategies, you said your strategies are multivariant, and there's no way, because of your structure, that one will affect the other. So they're diversified. And you basically said there's no way you can lose money doing this.
That's not what I said.
So tell me how you would lose money.
Listen, there's no systemic events that should be able to affect the entirety of our portfolio, right? So the main risks to us are not macro events like a stock market crashing or a fixed income event. It's more of a statistical anomaly over time.
Just give me a real example of that. No, Julian, I want to stop you there because that's where I misunderstand you because I'm just not as sophisticated as you. Give me a real example of what you just said. The rest, like something actually happening in the world, not the term for statistical analogy, but an actual example of what might happen that could be a statistical, something different you didn't predict.
I'm not trying to predict. I'm looking at odds here. So we're trying to make money on 53, 55, 56% of our trades. We make thousands of trades a year. Again, we never have beta exposure, or we try and limit our beta exposure, and beta just means market exposure. So we may be long and short. That way we're hedging out our market risk. And so again, in reality, our risks are very circumstantial, are very context specific, and it would depend on a confluence of all of our strategies, firing at once, basically in one single market for us to really have any kind of exposure. But again, we design it so that that's not the case. The real risk to our type of our procedure is basically if we've gotten the alpha development incorrectly. So if we have an idea of why a strategy should work, let's say we believe that again, oil goes up statistically on Mondays much more so than Tuesdays, Wednesdays, Thursdays, or Fridays. Right off the bat, you could see why that may not be a really valid system, because we don't have any fundamental reasoning as to why oil should go up on Mondays. But again, let's just say the data was convincing enough that we decided to deploy some capital to that. Again, the risk is that we just found a statistical anomaly that had no actual validity behind it and no predictability in the future. That is the risk, right? It's not individual systemic events.
Got it. All right, Julian, let's
name you like because I don't know what my positioning will be in 2 months or in 4 months. It is completely context specific.
Many of you listening right now don't have time to listen to every B2B SaaS CEO that I've interviewed. If you want to get access to the database I've created with year-over-year growth rates, customer accounts, margins, and many, many other data metrics and data points, you can go to getlatka.com. Here's the thing, though. That database, I keep it to myself. It's so freaking valuable. And to preserve the quality of the data and make sure that the people that have access to it have a true advantage, I'm only letting 10 companies on each month. So we're full this month, but you can go to getlatka.com to get on the waiting list for next month. And look, there's big people on the waiting list. I mean, the biggest VCs you've ever heard of. You've probably heard of them. They're big, private equity, billions and billions under management. So it's an impressive waiting list. Go get on now at getlatka.com. Guys, I get asked all the time, Nathan, you host all these interviews, hundreds of them per month. How do you do them efficiently? And guys, the answer is simple. People always agree to my calendar, back-to-back meetings. I batch my interviews to stay very efficient. And the way that I do it is I use a tool called Acuity Scheduling at nathanlatka.com/schedule. And the reason I use them is very simple. They keep my no-show rate very low because they send out reminders about when the interview or the meeting is coming up. And also, they make it very easy to schedule time, right? I don't have to go back and forth via email 10,000 times with people I'm trying to meet with. Okay, at nathanlatka.com/schedule. It helps me so much. And by the way, look, I have so many meetings. I'm the best at meetings. Okay, I do them back to back, very, very efficient. You guys know me. Many people say I'm the most efficient they've ever seen. Okay, so I use the tool. It's so efficient. And by the way, I got Gavin. I said, Gavin, he's the CEO. I said, I want a great deal for my people. He said, Nathan, well, most people get a 14-day trial. Isn't that great? I said, no. He's given us a 45-day free trial at nathanlatka.com/schedule. That's not going to stay up forever, so go get it now. nathanlatka.com/schedule. Great. Let's wrap up here with the famous 5. Number 1, what's your favorite business book?
Favorite business book, Market Wizards.
Number 2, is there a CEO that you're following or studying?
Paul Tudor Jones.
Number 3, is there a favorite online tool you have, like Acuity Scheduling?
Sure, quantocracy.com.
And what is it? Just quickly, what does that do?
Basically, it's a blog roll for all the quant blogs out there. So it just gives it to you all in one place.
Number 4, how many hours of sleep do you get every night?
About 6 to 7.
All right, that's pretty good. And what's your situation? Married, single, do you have kids?
Single.
No kids, right?
Turning 21 in 20 days, so
all right.
Well, less than that now.
And then take us back 10 years to your 10-year-old self. What do you wish he knew?
What do do I wish he knew? Multi-strategy. Basically, I 100% believe that my mandate, being a multi-strategy fund, is it's just the most conducive structure for performing risk-adjusted returns, because you have the most flexibility and diversification you possibly can. So it was really when I was 14 or 15 when I had that eureka moment. Oh, I can start using machines and automation to effectively allow me to do multi-strategy on such a scale. Because a human can only run 2 or 3 strategies being focused in on it. But to run 20 or 30, that takes automation. So, if I could talk to my 10 or 11-year-old self, I'd really try and get into to learn programming from that early age, because that is really the most practical skill you can have in this industry. Because like most industries, we are going the way of the quants. We are going automated. So it's just a matter of time.
There you guys have it from Julian Marchese. Started very, very early, right when he was 18 years old, set up $600,000 or about that much into his management fund, and then raised a separate, obviously, fund for the actual investment, $6 million there. Performing well. We'll see what he does over the next 5 years. Julian, we'll check in again later, but thank you for taking us to the top.
Thanks, Nathan. I appreciate it.
If you enjoyed Julian today, go back and listen to Tom yesterday. If you want to invest in Bitcoin but don't understand it, you want to make sure you go listen to that episode.